Leveraged loan versus high-yield bonds. Which one you should invest in? For investors looking to diversify their portfolio, understanding the differences between leveraged loans and high-yield bonds is critical to making informed decisions about the best investments. While there are some similarities in these investment offerings, a closer look reveals significantly specific risks associated with investing in each product. Is leveraged finance the same as high yield? Leveraged finance refers to using a combination of debt instruments and financial engineering techniques to fund corporate activities or transactions, often with higher borrowing levels. It is employed in various scenarios, such as mergers and acquisitions, leveraged buyouts, and recapitalizations. Conversely, high-yield investments specifically pertain to high-risk debt securities, such as bonds with lower credit ratings. Therefore, offer higher interest rates to compensate investors for the increased risk. While leveraged finance typically involves high-yield debt, it also encompasses an array of financing options not limited to high-yield investments. As a result, the complexity and context in which these financial instruments are utilized showcase the subtle differences and underlying nuances between leveraged finance and high-yield investments. Leveraged loan versus high-yield bonds. Which is better? Bonds offer a more attractive alternative to loans for both issuers and investors, primarily due to their flexibility and lower risk. Unlike loans, bonds can be traded in the secondary market, granting investors easy liquidity while enabling them to profit from market fluctuations. This marketability also benefits the issuer, allowing them to diversify their investor base quickly and efficiently. Moreover, bonds enable issuers to establish optimal financing terms, such as choosing the maturity date and interest rate structure that best meet their needs. Additionally, under a bond arrangement, the issuer is not obligated to repay the principal for a fixed period, allowing for better cash flow management. In contrast, loans typically impose strict repayment schedules and can pose a higher risk of default due to the obligation to repay the loan on a predetermined timetable. This heightened risk and the lack of flexibility make bonds a superior financing option for many entities. Why are leveraged loans risky? Leveraged loans, inherently bearing high levels of risk, have been a topic of extensive discussions in finance. Analyzing their prominent risk factors is crucial to fully comprehending the potential pitfalls for borrowers and lenders. At the crux of this issue is the substantial amount of debt borrowers assume, often with weak credit profiles and limited abilities to meet their financial obligations. Adding to this precarious situation is that interest rates on leveraged loans often float, exposing borrowers to fluctuations in the financial markets. Conclusion: leveraged loans offer floating interest rates and lower credit risk, providing a protective hedge against inflation and a relatively stable cash flow stream. On the other hand, high-yield bonds, with their fixed interest rates and longer maturities, carry greater sensitivity to market fluctuations and have the potential for higher capital gains. The choice between these financial instruments ultimately depends on each investor's risk tolerance, investment horizon, and market outlook. By weighing their benefits and drawbacks, investors can decide which option best aligns with their unique investment objectives.